Okay, guys, this is the data I said I was going to share with you in the last video, the video on SMT divergence and time and price opportunity. So I want to show you um, the data I gathered for, I think I started gathering that data from May all the way through June and then July. Okay, so when the high and low of the day was formed, okay, there are a bunch of other information that I also gathered in here, but I'm not going to focus on that. I'm just going to focus on the high and low of the day. Now, this is something you should be doing. Okay, this is something you should be doing. These are data you should be gathering. Okay, you want to know how often does certain things repeat. You want to have the statistics. Okay, um, it may be difficult. Okay, gathering this much data can be difficult. It can be difficult, but um if you are going to be a very good trader, these are data you should be concerned about, right? So you can see that on this particular day, the final daily direction was down. That is, it was a bearish day. I can see the high of the day on this particular day was formed during London open Q zone. The low was formed outside of the Q zone. That's what this empty line. That's what it means. And you can ignore that. You can just ignore that. Uh, the next day was also bearish. The high was formed during London open Q zone. The low was formed during New York Q zone. The next day, bearish. High was formed during London open Q zone. The low was formed during London close Q zone. Okay, so usually on a bearish day, you would expect that the high of that day should be formed between 2 a.m. and 5 a.m. New York time. Okay, and the low of the day will be formed either during New York Q zone or London close Q zone most of the time. Okay, most of the time. There are times when it forms outside of the Q zone, for example, here, it formed outside of the Q zone. And here, the next day, price was bullish. The low for that day, is it the low? Yeah, the low of that day, you can see the low of that day formed during London open Q zone, and the high was formed outside of the Q zone. Okay, on this particular day, price was up, the low formed during London open Q zone. Price is down, the low formed during London open Q zone. So you can see that pretty much all the time. There's only very rare cases that you have that price would be bullish and then the low would not form during the London open Q zone. Very rare, very few times. Okay, you can see only few times here um where it's not the case. Okay, so if price is down, okay, let me even sort this so that we'll look at down days first before the up days. um and now the direction, yep. Okay, so I'm looking at the up days first. Okay, when we have an up day, usually the low of that day would be formed during the London open Q zone. Okay, you can see out of how many times here. Let me count this. This is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 19, 20. Okay, out of 20 times, 1, 2, 3, 4, 5, 6, 7, no, 6, 7, 8, 9, 10, 11, 12, 12. Okay, 12 times, um, 12 out of 10. That's how many percentage? That's a 60% probability that price is going to form the low for that day would form during the London open Q zone. So if it doesn't form during the London open Q zone, usually it will form during the New York Q zone. You can see pretty much all the time. Okay. There is no time, this 100% of the time it formed within the Q zone. Okay. If it doesn't form during London open Q zone, you can see the other times it's formed during the New York Q zone. Okay, when price is bullish, the low for that day either forms during London open Q zone or it forms during the New York kill zone. Now, the times in which it doesn't form, this is also another data I gathered. I'm not going to show you that, but whenever the low for that day, if price is bullish, whenever the low for that day does not form during the London open kill zone, what usually happen is that there is a empty divergence. Okay, so usually there is a empty divergence where euro fails to make a lower low. Okay, euro will fail to make a lower low. Assuming it made a lower low during the London open kill zone, that would have formed a low for that day. Okay, because it failed to make a lower low, usually during New York, we're going to have a sweep. Okay, it's going to sweep the low that formed during the London open kill zone, thereby forming the low of the day. So these are things you need to see for yourself on the chart. You may not really understand it as I'm talking like this, but basically I'm just telling the insights I've gotten from the market based on my back test and from the data I was able to gather. If price is up, let me recap. If the day is going to be bullish, the low for that day will be formed during London open kill zone. If the low does not form during London open kill zone, usually what will happen is you will see a empty divergence in which euro or GBP USD is making a higher high while the other one is making a lower low. Okay, so if euro USD does not form its low during London open kill zone, you would usually see that GBP USD will form its own low. All right. And what will happen during during New York Hill Zone is that sometimes you are going to have a sweep of the London Open low. It's going to sweep the low during London Open, and then price will now start rallying up. Okay. And it's based on time. Like I said, it's based on time. So time comes before price. And if it doesn't form during London Open Q zone, like I was explaining, it's going to form during the New York Q zone. You can see 100% of the time it's only once that it formed during the London close kill zone. Okay, and the opposite, now that price is up, the low forms during London open or New York kill zone. The high usually would form in the opposite kill zone. Okay, the high usually will form in the opposite kill zone. Okay, so that this should be an error. This definitely should be an error. This should be London close. Okay, yeah. Even this is likely going to be an error because then let me change. I'll have to confirm that from the chart. I'm assuming that this is going to be, since price is going up, and I'll confirm that from the chart anyway. But you can see that most of the time this is the case. Okay, and let's go back to for bearish days. Okay, so for bearish days, you can see that how many data do we have here? We counted 20 initially, and we have how many data do we have here? Let me delete this. Mm, okay, we have 51 data. So you can just simply subtract 20 from 51. That's 31. Okay, so 31 out of 31 times that price was bearish. Okay, how many times do we have the low for that day form during London open Q zone? You can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. So 26 out of 81 times, sorry, 26 out of 31 times, so 83% accuracy. Okay, so 83% of times when price is bearish, the low was formed during London open kill zone. Okay, and this is a metric going to continue to track. I track this, I fill this in every day. Okay, at the end of every market, I fill all this data, I fill them in. Okay, and these are really valuable data, and I will also encourage you to do the same thing. Basically, what I'm tracking is I'm tracking the Asian range, okay, the deviation from the Asian range. I'm also calculating the deviation from the downward deviation from the Asian range, I'm also calculating whether we have continuation or reversal, okay, between New York and London open kill zone, whether New York reverses London or vice versa. Okay, so that's what I look at, and this right, wrong, right, basically the direction relative to the um 12 midnight time. Okay, so if at 12 midnight price first goes in the wrong direction and then goes in the right direction and then goes in the wrong direction and then goes in the right direction. So this these are useful. Okay, you can see most of the time based on this data, most of the time um price will first move in the opposite direct in the right direction before moving in the wrong direction and the right. Let me just show you so that you understand what I'm saying. I'm not supposed to be showing you this, but let me show you this as an example. This is the daily chart. So you can see what this means. You can see that price first move in the right direction. Okay, the daily um bias is more like bearish. Okay, because once it is beyond 12 o'clock or 11:10, you shouldn't be entering any new trade. Okay, so this is the open time. This is midnight. This line that is midnight time. Okay, midnight time, and you can see that immediately after midnight, price first drop down. That is the right direction for the day, and then it rallies up wrong direction. This wrong direction is the Judas swing. Okay, that's the Judas swing. It usually happen during the London open kill zone. Okay, and that's usually when it will form the high for that day. You can see that the high for that day was formed, and then price then drops, goes in the right direction. Okay, and that completes the London um section before we now start the New York section and then moving into the London close. Okay, so London open, um, right, wrong, right. Okay, that's basically the metric I'm tracking there. Um, Okay, there are a bunch of other metrics that I'm tracking. Basically, I'm checking also where does price draw to for that day. You can see how the previous day low and the previous day high are featuring most of the time. Weekly low, you know, are featuring most of the time. Okay, and you can see where the rejection zone for um for the Judas swing. Okay, this Judas swing rejection zone, like when there is a Judas swing to the upside, where it usually reject from. Most of the time, you can see that most of the time it rejects from a fair value gap, fair value gap, fair value gap. Fair value gaps are repeating pretty much all the time, pretty much most of the time, fair value gaps. Okay, so these are metrics. May say that maybe I'm obsessed about data, but um when you have data to back up your trading, okay, to back up your decisions, why you make certain decisions, um, it helps to it helps to it builds your confidence. Okay, you know that you have the data, you have data that you have tracked over time. Okay, this is not enough data. I mean, this is just 51 um count, 51 days. That's it's not enough data, but I intend to continue to keep track of it for the rest of this year. In fact, forever, I'm going to continue to keep track of this every single day. Okay. And whenever I have more time, I can also track back on the historical data. The challenge I used to have with the historical data is that TradingView does not usually show the low time frame 1 minute to tell you that you don't have the data for that as far back as May, April, or the likes. Okay, that was one of the reasons why I stopped. All right, but I'll continue to track this data. So I'm curious to see what it will be within the next 1 year. Okay, I want to see how often the high of the day on a bearish day is formed during a London open kill zone. You can see this is data. This is something that can help build your confidence. So if you have a bearish bias for that day, and you know that London open kill zone is going to form the high of the day. And where is it going to reject from? Okay, you can see, like I showed you, most of the time it usually rejects from a fair value gap. Okay, most of the time, fair value gap, usually to sweep liquidity into a fair value gap plus other block and then reject from there. So If you know this, all you need to do is to mark out the fair value gaps and the other blocks and the liquidity zones that are at both the midnight New York open time, okay? The open time at midnight, New York time. Um, Once you mark out your fair value gaps and your other blocks, you know that is where it's going to reject from, okay? And you start watching price between 2 a.m. and 5 a.m. New York time, okay? So once price rallies up, okay, you are watching price, you want to see where it is going to reject from. And then once it rejects, you know that when it start dropping, most of the time the high would have been formed. Once it is past 5 o'clock, you can almost always be certain that price will not come back to sweep you, except if an SMT divergence is going to maybe later form during the New York killzone and sweep the high before dropping back again. Okay, well, 90% of the time, um, you would usually see that the high of the day would be formed in London open killzone and price would most of the time not return back there. Okay, because let me just show you a few more examples. You can see from Here's another example. The high was formed during the London open kill zone. Alright. I think I've showed you this. Okay, let's look at another example. You can see from here, this is London 2 a.m. to 2 a.m. This is midnight New York time. Okay. You can see London open, you can see how price rallied up into another block. Okay. This other block also has a fair value gap. Okay, rallies into it and then drops. You can see price never came back there. Okay, the rally started exactly at 2 a.m. Exactly at 2 a.m. and the rallies up into the other block and then start dropping. So you can be sure from that, okay, the high once it is already 5 a.m. okay, and you see a trade opportunity here, you can see from here you have liquidity zones, you have other block, up close candle, price taps into it and then rejects. Okay, so when you see this, you can be confident. If you want to like be super sure that, okay, I'm not going to be taking that, maybe you can just place your stop loss here, okay, or here. So you know that you are confident enough that, okay, price will most likely not take out this high, okay, because the high of that day usually will be formed during the London open kill zone. So you can place your stop loss there and then trust that price will not get there and then continues down. At least you get at least a 1 hour or a 2 hour. Okay, so let me show you another example. Okay, you can see this is midnight New York time. In this case, we didn't have that much of a rally. You can see the fair value gap between this candle and this candle. It rallies above the New York price into that fair value gap and then started dropping, then drops. When did the high formed? The high formed during the London open queues. You can see this is the high for that day, and started dropping from there. Alright, so the trick here is you need to have a bias for that day. You need to, based on your top down analysis from the weekly to the daily time frame to the 4 hour time frame, 1 hour, 15. You need to have a bias for that day. If you don't have a bias, you have a hard time trusting this. Okay, once you have a bias, you know that, okay, price is most likely going to be bearish for that day, or price is most likely going to be bullish for that day. Then you wait for the low or the high to form during London open Q zone. Or what I do is sometimes I trade the Judas swing too, okay? Because I know that during the London open kill zone, there will be a Judas swing. If price is going bearish, there will be a Judas swing to the upside. So if I'm seeing liquidity, short time highs that have been formed during the Asia kill zones, I know that those liquidity will be swept, okay? And I see a clear and obvious fair value gap or another block. I know that liquidity will be swept into that fair value gap or the other block and then to drop from there, forming the high for that day. Okay, so I can short it and probably even hold my position all through the rest of the day. I don't like to do that. I like to enter and exit and enter and exit. But you can do that. You can do that. Okay, that's what you call a one shot, one kill. Okay, push shock. Let me show you a few more examples and then I'm going to end the video there. Okay, so here price formed. This is not the okay. Price was bearish for that day. You can see this is market close. Price was bearish. Okay, this is midnight New York time. Okay, this is Asia range. Okay, you see the short term lows that formed, short term low, short term low. Those are liquidity. Okay, you can see the fair value gap here and the other block here, this tiny other block. See, exactly at 2 a.m. New York time, price rallied up, took out all the liquidity that formed during the Asia kill zone, and and it took out those highs, the liquidity on those highs, and tapped into the other block, this tiny up close candle right here and the fair value gap, and then drops from there. Okay, this is time and price. Okay, so time before price. Okay, so when you see me post certain things, I'm expecting price to rally up, I'm waiting for Judas swing to form, or you see me, accurately predict the market with a near perfect accuracy. Okay, these are the things that I'm looking at. These are the things that I'm watching for. Okay, you see me draw these things on my chart all the time. You see me draw the initial um range. Okay, usually most of the time when you see price rally above the initial range, you can almost always be certain that that day is going to be a bearish day. Okay, and vice versa for bullish scenarios. Okay, let me show you maybe two more examples and I'm going to end the video there. Okay, you can see same thing. This is London open kill zone. You can see this is midnight New York time. This line, that is the open price during midnight New York. Okay, you can see price rallies up exactly, almost exactly at 2 a.m. Okay, price rallies up above the midnight open price. It rallies up into where? Into another block and a fair value gap. You can see the fair value gap here. Okay, and you see the liquidity that formed during the HRQ zone, short time high, that's an equal high, that's liquidity. Okay, that's liquidity, all right, and then price rallies up, drops, that is your setup. Market structure shift, rallies into this fair value gap, another block, and then sells off for the rest of that day. So this is why you see me tells you that you should only be looking for setup during the kill zones. Okay, you want to be looking for setup during the kill zone. You can see the high for that day formed between 2 a.m. and 5 a.m. New York time. Okay, this is how the algorithm that delivers price, this is how it is configured, this is how it was designed. Okay, it is algorithm, it will repeat, it will do this and it is not going to change. Okay, week in, week out, it will not change. Okay, so one more example and I'm going to end the video. Okay, the day was also bearish. Okay, you see from here, um short time high, this is midnight New York time. This is the open price extended outward. So what you want to see, you want to see that price rallies above the open price into another block or a fair value gap. You can see from here, you can see this short fair value gap partially filled here and then completely filled here into this other block, up close candle, okay, into this other block, rallies into it, and then drops. And then the low of the day formed during the New York Q zone. Like I told you, I explained in the time and price theory, the previous video, I told you that New York extend all the way to 10 o'clock. Okay, so New York is actually joining, like it continues into the London close Q zone. Okay, so you can see the low is forming during the New York Q zone, and um, price rallies up from here. Okay, so You can see the high formed during the London Open Q zone as well. Okay, so that's more than enough examples. You can go into your charts and look for even more examples from your own end, all right?